We're discussing Chapter 10, Stockholders' Equity. I do want to point out that there's quite a few portions that we're going to skip. In 10.2, we're going to skip stated values and other than cash issuance, so cash for a building or car or like legal services. On treasury stock in 10.3, purchases only. We're only going to do the purchase of treasury stock. We're not going to do the resale. And then in 10.4, we're just going to cover the stock split. We already know about cash dividends in general. We're not going to do the details. And we're going to skip stock dividends, which are different than cash dividends. We will talk a little bit about different stock values in decision making. That's more of a foreshadowing for chapters 11 through 13, where we get into financial analysis, and we're going to skip objective 6 altogether. Okay, so corporations can take on many different forms. So you learn about partnerships. Partnerships, proprietorships. Let's start this over. I'll start with the proprietor. Oh my gosh. Proprietorship. Partnership. And LLC, limited liability company. And then there's corporation. So we are going to be focusing on corporate reporting. Most of the accounting, virtually all the accounting actually, that you've learned applies to proprietorships, partnerships, and LLCs. That is, accounts receivable for sales revenue, allowance for bad debts, how to account for interest. All that accrual accounting would apply to proprietorship, partnership, and limited liability corporation. The one section that's a little different would be the equity section, but we're going to focus on corporations which issue shares of stock. So fractional ownership. You can own 1% of the company, 0.0001% of the company, 50% of the company, 100% of the company, and these shares are transferable. Proprietorship, this is one owner. Partnership, 2 or more owners. LLC, 1 or more partners. Okay, and the big difference with the corporation is you're going to have these shares, and they can transfer from one investor to another. Generally, in an LLC, partnership, and proprietorship, the owner is typically also a manager. So they're involved in the day-to-day running of the business. Corporation, smaller corporations, it may be true, but it's really ought to be the case that the duties of management and the shareholders are separated. So in your law class, you might hear about the separation of management, MGMT, and ownership, called the corporate veil. And what does this mean? Then if you have this corporate veil, then the investor liability is limited. And the biggest liability typically of a corporation that we're talking about is the debt. We're not talking about slip and fall liability where you get sued for an injury. Usually that type of liability is insurable, although, not always. You have things like asbestos and other injuries that occur that are not necessarily insured. But generally what we're talking about is the debt. So the corporation can't pay the debt from its free cash flow, so they come after the owners. If you have your own business as a proprietorship and you take out a loan, it may be on paper in your company's name, but the bank has the right to come after your personal assets. With a corporation and the corporation, that's generally not the case. I will say for small companies, sometimes the owner does what's called endorse the loan, which means the corporation is liable, and then the endorser on the note is liable. But generally, to have a standalone corporation have its own credit, have its own debt, and then the investors are only responsible for up to their amount of investment. All right, and this is very, very important. I mean, in the history of economics, once limited liability was settled in the courts, investment really took off, and capital markets really took off. Okay, so we're going to be focusing on corporations with owners not involved in day-to-day operations.